Welcome, everyone, to Name Confidential Live.
Welcome, everybody, to Name Confidential Season 2, Episode number 44. I'm your host, Ben Fox, and today I have the pleasure of introducing our speaker, Brad Hartman with Hartman Financial Planning. Welcome, Brad, and thank you for coming.
Well, thanks, Ben. Thanks for having me on. Good to see you again.
Yeah, you too. Yeah, not Outlook wasn't that long ago.
No, like 3 weeks, I think, something like that. Time's flying, as they
Oh,
say.
yeah, it is. Especially when you have a crazy week like we did in the market, too.
What do you mean? Hardly went up or down. What are you talking about?
Oh, yeah. Well, we always start off with the name exposure index. So I'm going to share my screen here for a second. And then, as a reminder, the name exposure index represents the average equity exposure reported by our members. And it looks like this week we're sitting at 86.56, which is just down about a point from 87.87 last week. The one thing, though, that I do see in here is we finally have somebody who is a little bit bearish this week. So they probably did all right.
Depends about which half of which day.
That's true. Yeah.
Wait, after yesterday, cheapers. So, anyway, well, that's interesting. Now, that's actually, I'm kind of close to the average with mine, so I do submit to this. I try to do it every week. Sometimes I forget, but I probably get 80% of the time I put my number in. So,
Yeah, we're always an outlier at Scarecrow. We're either 200, 0, or negative 200. So
yeah.
you always have an idea if we might be one of the negative 200s in there at times with our strategy. But yeah, we were holding long through this, so it's been a little bit of a roller coaster. But and speaking of roller coasters, I
That's a good segue.
I feel like that's a good segue into our conversation.
Yeah. So, as a lot of the name people know, because we were in Outlook in Chicago just what 3 weeks ago or something thereabouts, beginning of the month. So it hasn't been all that long. So I actually am a former Disney guy. So I did used to build roller coasters. So that's my little tagline now is yes, I used to build roller coasters. Now I ride them in the stock market. So for my clients. So, and this week was definitely a roller coaster week, especially yesterday. We were up. We opened up. We went up what up and a half, 1.5%, I think, in the morning, and then I took and sold a whole bunch of stuff. Took my kid to school, and by the time I came back, it had already come back down again. And I was like, okay. And then it just kept going and going and going. And I think we were down almost 1.5% by the end of the day, right? So give or take.
Yeah, it was like a complete reversal. I remember I went to a meeting and I always give a report on how we're doing. So I'm like, well, here's where we're at year to date, but based on how it looked this morning, we might be getting a nice little bounce back. And then I felt like a liar because I left and I looked at it and I'm like, actually, that's not the truth. Okay.
Yeah.
So,
Yeah. In hindsight, I wish I'd taken more stuff off in the morning, but that's okay. I do a lot of options stuff and some of it was expiring today actually. So I said, let me get all that stuff off that's the profits have come into and get it off while they're up. And then I have stuff that doesn't expire till the end of next week, which I'm kind of bullish for, and stuff the week after that. We can talk about that in a minute. But so,
okay.
and so I just thought if you're okay, I was gonna sort of just tell you a little bit what my background is and how I got becoming a financial planner, and then we can go to some of the market and some of that other interesting stuff, if that makes sense. So,
Well,
so yeah,
definitely. You can guide. I'll follow.
there you go. But so yeah, I used to be an Imagineer, and actually when I ended up changing careers, first of all, I was already helping people at Disney do their 401k choices and healthcare choices and pick investment choices. And I had started an investment club with some other people in my department, in the engineering department, and I was an electrical engineer. You know how us engineers are. But so we had put that together. And then I was actually in France. I had lived in France for 7 years, and that's where I got hired by Disney to build the Disneyland Paris park. Came back, and then I was doing Buzz Lightyear for Paris. And so my wife took 6 months leave of absence, and we had our first child there. So my son does not get French citizenship, but he can ask for it later if he wants it. But anyway, they're giving me a hard time about taking 5 days off after I've been crawling on a ride tracks at 2 in the morning. And I was like, really? So much for the family friendly workplace here. So anyhow, that's when I decided that I was taking the CFP program in the evenings at UCLA. So I finished that up and then passed the CFP exam later that year. And so I took a package and layoff package and started my own firm. And that's kind of how I ended up becoming a financial planner. So
I just love the parallels between the roller coaster and how you ended up over here. It's funny how life works like that.
yeah, I not none of this was planned. I never planned it. I know people like spend years trying to get into Imagineering. I was actually in Paris working on a project for Kuwait when Kuwait got invaded. And I had a girlfriend that wanted to stay in Paris at the time. So Disney was hiring because they were building a new park. And so that's how I ended up getting in there. And then I built a Space Mountain over there, my last project. And it's actually kind of cool. It's based on Jules Verne from the Earth to the Moon. And it's got a catapult basically inside a cannon on the outside of the building. So you get loaded into this cannon and then you get shot up by the catapult. It's got a hook that pushes the train. And it goes back and does all these inversions, all the stuff. Very different than the US version of Space Mountain. So did a good job on that. So they invited me to come to California, and that's how I ended up in the land of granola and nuts that I said I would never live in. And so here I still am, 25, 30 years later. So there you go. So life is what it is, but that's why we all smile and enjoy it and take advantage of it. So,
Definitely.
so one thing I do want to mention is that I'm a part of the NAAIM Financial Planning Mastermind Group. So those that are in NAAIM haven't attended yet, please do. We have a lot of interesting stuff. Brandon and I did a presentation at Outlook 3 weeks ago about financial planning and tax planning. And so I can say that it's a big part of my practice. I think also in your firm too, Ben, as well. But some people are just money managers, but I do financial planning and the money management. I think you do both, don't you, Ben?
We don't do a ton with, I work with a lot of financial planners locally.
Okay.
Um, our strategy is used as an element within that, but like Roth conversions and all that kind of stuff, we do kind of help out with financial planners who use us.
Okay. So anyway, so for my clients, I won't spend a lot of time on it because we'll get to other stuff. But one of the things to do when I bring up a client on board, I look at what their risk is, what their goals are, and then based on that, figure out how much risk we really need to take with their money. Because some clients might have enough funds that they don't need to take a lot of risk. So I'll take less risk than I don't want to take more risk than I need to necessarily to make sure they have a comfortable retirement. And then the NAAIM, we have so many different people doing so many different types of strategies and stuff. So mine's kind of a hybrid. I have some like a base that I put in with dividend paying stocks and closed end funds and so on that generate interest and income. So that might make like 5.5 to 6% a year, maybe a little bit more even just on that stuff. So regardless what the market does, they're getting that income every month that's coming in. And then I'm an options guy, so I have my volatility strategies. I had done something at Shark Tank quite a few years ago. So I like to short volatility when things get very juicy. That's one of my favorite things. And then I also use option strategies like calendars and butterflies and so on some of the indexes and some of the high flying stocks. So that's kind of my spice that I add on top of the stuff. And then I'll do I call it more strategic than timing, I guess, for indices and other ETFs. So when I see buying opportunities, I will get in if we've had a good pullback and then, sell it once we get a nice run up. So I'm probably not, you guys are more systematic, I think, of going like full bearish, full bullish and so on than I am. So
Yeah, no, we definitely have a lot of all in, all out components in our strategies.
yeah. So I have sleeves that do that, but not the overall portfolio. So I think that's probably the biggest difference for that. And then I do some tax planning as well, Social Security and Medicare planning. So
For the strategies, so the ones that you're mentioning here, are they all your own, or do you use some third party money managers for that, or
all my own is what I've been using. I know
okay.
I've been tempted by some of the returns I've seen in the NAIM group. So and now talking to Susan, it sounds like I should just put my money with you and then can retire. So I don't know. I'll think about that. Yeah. So do you guys use any third party or you do everything in-house?
No, for us everything is in-house, and we're usually, a lot of people use this in a sleeve as a percentage. We're usually a small percentage being on the more aggressive side.
Right. Right. That's the way I do with the volatility and the option stuff. It's a smaller percentage than some of the other stuff. It's more aggressive and I'll just be honest, you don't want to have that much volatility because it makes clients nervous if they have that much volatility in the whole portfolio. So
And they always think that they can take on more risk than they actually really can, is what I've noticed.
really,
Yeah.
I I have one client. He's like, "Oh no, we'll just put it all in the the NASDAQ, it's fine, da, da, da. And then I remember we were down 30% or something one year. I was probably 22 or whatever was paying, pulled back. And he says, well, how come we're down so much? And I said, well, you told me you're fine with all this risk. I did a risk questionnaire, and then I gave him a new risk questionnaire. He was like a 70 or 80 out of 100. New risk questionnaire, and then he was a 9 that month, right? So I said, well, I think we need to probably find something in between here.
Right.
Because if I'd asked you this 6 months ago, you still would have been a 75 or 80, but now you're like 10 or 15, right? So it's kind of big.
That's true. Yeah, the recency bias can really impact where you as a person end up on that risk questionnaire.
Yeah, big time. And the other thing I've recently taken on, and we talked about this at Outlook, I did a little presentation on it, is sort of the tax planning. One of the things that a lot of CPAs do is they want to minimize your taxes this year, but they may not be looking at the long-term effects of it. And so one of the big things that happens is, especially since we all get outsized returns for our clients, they'll have these big IRAs later in retirement, and they're going to be paying some big taxes on the RMDs because those RMDs are going to grow over time. So this kind of shows a couple approaches where one is if you basically try to minimize your taxes at the beginning, you're going to have these light blue ones show up later, you're up in a higher tax bracket. So you're paying a lot of taxes. But what we can do is stuff, for instance, what I'll do is when clients first retire, they may not start Social Security until they're 70 or 70 years old, right? So there might be 4 or 5 years where they're not really have much income. So I take those 5 years and basically take extra money out of the RMD, out of the IRA, either convert it to a Roth or just use it for living expenses, but try to spend down the IRA sum during those lower tax years and fill these lower tax brackets. That green one is the lowest tax bracket. And then that way you can keep it in most of it in the lower tax bracket later on. You can see where the dark blue stays under the green for many, many years. This here is where a spouse dies. And so you change tax brackets because now you're filing singly rather than married filing jointly. And so you just
Got it.
higher tax bracket. But
So do you look at a lot of like maximizing the tax brackets before they make bigger jumps then too?
I try to, yes. Yeah. Yeah. And I was actually surprised how much you can save. I have to say this is a client that has a little over like about 1.3 million. So they're not like a super wealthy, but looking at we can save up to $380,000 in over the lifetime of taxes. I mean, if you can save 15-20% in taxes, it's easier to do that because it's a sure thing as opposed to trying to get extra returns, right? So that's an advantage to that.
So when you say about focusing on taxes and like not planning outward, like what is one of the biggest mistakes that you see?
Well, what I find is that the financial planning software and the stuff that I use too assumes that what you should do is keep everything in the tax deferred accounts as long as possible and spend the non-tax protected stuff like the regular brokerage account, right? But the problem is that when you're doing that, then those IRAs are growing for a long period of time before you start taking the money out. And now that the RMDs don't start until 73 or even 75, those accounts are going to grow to astronomically large accounts, right? So you're going to pay higher taxes, but in addition to that, you have to pay an IRMA surcharge on your Medicare insurance. So you could go from instead of paying 290 a month, you could go to like 380, 470. I think next one's 5 something. So you could, in theory, pay an extra $100 to $200 a month on your Medicare insurance in retirement. That alone is a few $1,000s just on that. So if you can modulate it better and spend some of that stuff down or convert it to a Roth IRA, so you're getting it out of the taxable IRA to a non-taxable account, completely non-taxable, then long-term you'll save money. You're going to have to fight with the CPAs a little bit because they're always looking at how can I have you pay the least amount of taxes this year as opposed to 10 years down the road, right? But and this was an eye-opener to me because what I always thought for Roth conversions was it's really just the tax rate you pay now versus the tax rate you pay later, right? And most people, let's say that we work with, a lot of them making, 6 figures, right? So they're in a high tax bracket during their earning years. They may be making 200,000-300,000 or more. And so they're already in a 35% tax bracket. So I would have said, oh, they're going to retire. They're going to be back down to 20% tax bracket. But the fact is, because of these RMDs and the Medicare surcharges, it's not as simple as calculation as that. It gets much more complex. So you really have to model it and see how it looks over time. So that was an eye opener for me that really in the last 6 months or so. And then it just kind of just shows the RMD growing over time. So if we can convert this stuff here, because here the RMDs basically don't exist, right?
Mhm.
But here, by taking that extra money, then we can keep these RMDs down at a much lower amount each year rather than having to grow over time. And so it does make a big difference. It's a case-by-case basis. You'd have to look at each client and see what makes sense for them, but definitely something to consider.
Do you work closely at all with any CPAs then to kind of help manage that process for some of your clients?
Just basically the CPA ad that they already have for the most part. I haven't like set up a center of influence. I guess I probably should. This has been in the last year that I really figured out how important this is. So I've
Okay.
done it much more than I had in the past. Um, and the changing of the dates for the RMD distributions are, that has affected things a lot too. Because before they were basically taken by 70, and so you were kind of
Mhm.
overlapping the end when you started Social Security. But now you're going to have even more years that you can basically take Social Security and not take RMDs, put them off. So you probably want to look at taking some money out earlier. And then one of the things we did and this is just so the portfolio grows for a larger amount as well with loss conversion because you're not taking out money later. And then one of the things we kind of did for the NAAIM outlook was Brandon and I tried to put spreadsheets together so that everybody doesn't have to go out and buy the software. And so this is my cheap man's version of the this comment. But you can do a ton of stuff in Excel. I just took Excel and basically built it with the formulas and then added some graphs to it. And you can see the same thing here that if I'm taking my green case, I'm filling in these 20% tax brackets for the first 5 years before they start RMDs. Then I'm dropped down to a low RMD over time. It really allows my portfolio to grow bigger if I can convert it to a Roth. So, but just something that if you're a financial planner and you're not doing that, even if you didn't want to get into full-blown financial planning, these are discussions that you could have with your client and give them some illustrations, and they'd say, "Oh, that's interesting," and they can work. You could work with their CPA, or you could find somebody else to help you maybe get the details put together. But at least it's a discussion to have, and it adds value. It makes them a little stickier client because they're saying, "Oh, I'm getting not just the investment returns, but I'm getting some decent advice too." I don't know what your thoughts are on that, Pat.
No, I 100% agree. I mean, I'm a part of a local group in Minnesota. We have, they have like couple CPAs in there, and there's one CFP in there that we work pretty closely with, at least for some of our local clients, because we do have clients across all of the United States.
Right. So, yeah, just something to consider. And then I thought if you want, we can talk about the market a little bit, unless you had some other questions about it. I didn't want to spend my whole time talking about me. So,
Well, what are you seeing? Because it was a crazy week. There was a lot of movement.
yes, let me go down to the zoomed in version here. No, no, I'll come back up. Okay. Yeah, so this is going back to July. So I cut out the whole thing. But what I was looking at here to me was interesting was the fact that we had this huge red bar. What about the middle of so almost exactly a month ago, right? No, not a little longer than that, like 8 weeks. So October 12th or something like that. So I guess about 5, 6 weeks ago. And then we've sort of worked our way back up from that pullback. And can't remember what the news was that day actually.
I'm trying to think back to it as well.
There's probably I think it was China tariff stuff with Trump, right? I think he tweeted something about that he wasn't going to go to the meeting with Thing Pow because they weren't working on the tariff agreement. I think that was the day, and then all of a sudden it dropped.
yes. No, yep, that sounds right.
Yeah, and we sort of ground our way back up again here to our all-time high again, and then we just had some news this way and that. But what I thought was interesting, even with that huge pullback we had, and this was yesterday. I mean, it's just insane, right? We opened the morning up here and then came down here for the close. I just thought it was interesting that we kind of held the same level. So I'm just keeping an eye on that.
Yeah.
This is the 50 moving average here. So we are below it still. We above it and then dropped below it. And we got back. I'm not sure exactly where it closed. I took this earlier today, but I think we might be a little bit higher than that. What are we at 66.40 or something? I know it pulled back a little bit to the close. So I'm not sure exactly what we closed at. Use my phone.
6603.
Okay, so we're a little bit
Yeah.
lower than I'm showing there then. Okay. So we took back maybe a third of that big bar from yesterday. Okay. So anyhow, that's what I'm kind of looking at that. I mean, and then if you go back to the bigger picture, so we are still up near all-time highs. I mean, it feels like it's, oh my gosh, but in the big picture, it's really a blip, right? So if you're looking at it long term, of course, us active people don't look at it quite that long term, but I'm just saying for the average investor, we're still near the all-time highs after our big drop in April. And one of the things I was going to say is I thought was interesting is look at Bitcoin for the year because everybody's touting Bitcoin these days. I have my own personal opinions, which I hearken it to the Dutch tulip situation in the 1620s, I believe it was, where everybody bought them because they were scarce and it was the thing to have. And I feel that way a little bit about Bitcoin personally. Do you have any clients asking you about Bitcoin?
Maybe 5%, and I've probably heard it more in the last 2 months on our thoughts than in the last year or so. But it's about 5%. It's not a big portion.
Okay. Yeah, man, I'm kind of brutally honest with my clients and say, I don't see I don't see the fundamental value in it. It doesn't do anything. It's just numbers. And they say, oh, well, it's just like gold. And I said, well, gold, you can actually build electronics and jewelry and spaceships and things with it. So it actually has an intrinsic value, but that's my thoughts on it. I just thought it was interesting to see the S&P is actually up 12% for the year earlier today anyway, and Bitcoin's down 15%. So there's a huge disconnect there. So I think, people tout Bitcoin as like to reduce volatility that's not correlated, but when we've had these big sell-offs, gold and Bitcoin and this market all went down at the same time. So I'm not
Well,
buying.
it's interesting because didn't we had a talk at Outlook about Bitcoin,
Yes.
and I'm trying to remember that he was thinking that like somebody brought up the 4 year cycle, and he thought that that wouldn't be the case, but we've seen it just dropping since we've been at Outlook.
Yeah. So I don't know. I mean, I think it could be an argument. I guess if you really concentrate on that, maybe you could learn how to trade it. I just don't really know what the underlying forces are that make it go up and down, except it sounds like there may be some of these kind of Reddit groups or something that are doing that, right? Like the GameStop and that kind of stuff.
No,
I think he had something about these social media groups or whatever that were like involved in the crypto trading, but I don't know.
there definitely are those. It's crazy how much influence they can have, or how much influence they can build up over a short period of time.
I mean, let's face it, over 5 years, okay, it's up 3.5 times your money. So I mean, well, depending upon when you bought, right? So there's a lot of, it's very versus, the S&P's up, let's see here what I have. S&P was up 12%, I think, on average. So no, actually it's more than that's the wrong chart. The S&P was like no, it was still like 1.5 to 2 times your money. I thought I had it in here, but it wasn't 157%, but I think you're up like 80, 90%. It was around 87% over the 5 year period. So it's still a great return in the S&P without all this volatility. So
Now, I will say with Bitcoin as, a company that uses a lot of leverage, we do tend to, or at one point we had a lot of people who were trading Bitcoin and just got tired of trading it and wanted something more aggressive but safer. And it was the first time at Scarecrow that we were considered safer than a lot of the investment options out there.
oh,
Um, so so I do like Bitcoin for that sense because it
okay.
allowed leverage strategies a little bit more weight out there.
Oh, that's a good point. So it increases the appetite for risk, and so you look less risky. Okay. The other thing that I look at is because I'm a volatility guy and options guy. I look at the VIX term structure, which right now, even though we've had the drop, is actually we are in contango, which is the normal state. So basically, more risk out in the future than today because the market doesn't know where we're going to be, 1, 2, 3 months away from now. So that's kind of typical. But we are in contango, 0.78 reasonable. It's not real high. Sometimes it'll get up to over a one and a half, but we are also below the VIX spot level, which is a good sign. If you look back at April this year, I just wanted to get a comparison. At that point, we were what we call backwardation, where the front month is higher than the subsequent month. So there's more risk today than there would be in the future. People had more fear today than they thought out. They thought long term it would recover. So that's kind of the typical. Um, so this is April and this is today. So this is, if you see this dark blue, that means people are pretty comfortable. They figure the market's going to do okay. This light blue, this will happen when uh, the market's dropping hard. People are out buying puts, maybe short-term puts to kind of hedge their portfolios. And so that drives up the IV, the high volatility of these shorter dated options. And so then you get this what's called backwardation situation. And then that's when I don't like to trade volatility unless I'm long it, but usually I try to go short because that means that the reality is that VIX is probably going to stay elevated for a while. It's not the best time to be figuring that volatility is going to settle down. So
How long do you usually hold your positions?
so for the volatility stuff, got an algorithm that does it, calculates it for me automatically. Those have been anywhere from a couple weeks to like 3 to 6 months, even.
Okay.
So it really just is a situation. Now, I did. Okay, so full disclosure. So when I first started doing volatility stuff, and now this contango, in theory, I'm sorry, the backwardation normally doesn't last very long. Usually within 2 or 3 weeks, it settles down because all the fear, people get tired of the fear comes out of the market, and this settles down. I remember probably back in 2010 or 2011, a long time ago, that I said, well, look, this thing isn't such high backwardation. There's no way it can stay that way longer than a month or two, right? It's going to settle down. 6 months to stay in backwardation. Creamed all my positions at that point in time. Luckily, they were very small because I just took small ones. I wasn't too sure. That wasn't following my algorithm, but I was just kind of like, it's like when you see the huge dip, right? You're saying, okay, my algorithm may not say that it's the time to buy the dip, but this dip has just overdone it. I got to buy something because obviously it's going to bounce, right? Not always.
That is the thing that I noticed very early is just the impact. There were a lot of name strategies, and I came in under my father and, Shark Tank and all that. We would watch some of that stuff, but the impact of emotion in your own strategy and managing that. I can't tell you how many times I've sat there and looked at whatever the Scarecrow signal is, and I'm like, what are you doing? Why are you trading to cash? Why are we going to cash? Or why aren't we in cash? Kind of thing. Or like what? So it's amazing as you have strategies, figuring out how to also balance your emotion and understanding. It helped me really understand clients too. Um, and when we moved to the retail side, the emotions that I was having, the clients, if they were paying really close attention, were probably having that amplified because I had all the data.
Right.
So that's, I don't know, it's just always been something interesting to me.
Yeah, it's so easy to, well, that's different this time because look at this
Yeah.
news or that happened or somebody launched missiles in the Middle East or whatever whatever the cause is, right? And then if you just, I mean, that's a big advantage of back testing, right? I mean,
Mhm.
back testing doesn't necessarily prove that you're going to make money in the future. Hopefully it shows you have an edge and there's an edge to your thing. But part of it also is just for you to say, okay, I've done this, I've tested through this, I know what happens, and sort of trust your system and believe in it, right? Part of it's just getting a belief, I think, in your system.
And I think also knowing your strengths and your weaknesses in your system. No system's perfect. So
Right.
just as much as you understand when it's going to be performing really well, also knowing when it might be underperforming and why it is that's the case. Like I know our strategies struggle a lot with some of these quick corrections that we see in markets. It's not going to catch that. We're going to ride it out. I always tell advisors and clients that it's not something that our systems are really good at catching. But when we go into extended bear market conditions, then our systems do perform a lot better. Um, but that was something that I think, when I first started, always drove me nuts because I'd see the first like 10% correction, and I'd be like, why are we not trading, or why did we just now trade? Like, what was the reason for this? And then I had to understand what it was that was leading to that in the system, and why that was kind of a weakness that I could see. And then knowing that weakness allowed me to be more confident going forward because I knew where kind of the blind spots were.
Patience is one of my things I need to work on still too, because sometimes I just say, okay, the signal's not quite there yet, but gosh, this has got to be the time to get in. I'll probably get in a day earlier than the system says, and I'll do even better, pick up an extra 2 or 3%, right? And you're like,
You know what helps? I'll tell you what helps is having somebody else in the business has helped me a lot. Like before I would talk to Len, I'd be like, I'm so frustrated with the system. Let's just come together and realize what's going on, why it's going on. Now it's Spencer and Kirk and so on.
right,
Um, but sometimes just having somebody like you almost as the advisor or as a model creator need somebody to then kind of handle your emotions because you're at the top because you're the one that's going filtering all the way down usually.
right.
So,
Your own accountability team or accountability coach, right?
right.
Exactly. I hear you. Well, that's why I actually have a small group of option traders and we have our team's channel. So that actually helps me too, because just doing it by yourself in the corner is tough. You can sometimes you can reach out, somebody says, oh yeah, but don't forget, such and such has earnings 3 days from now. I'm like, oh yeah, you're right. I missed that part. Thanks for pointing that up. So let me hold off and we'll do that next week. Yeah, it's true. So we talked a little bit about that already. Oh, so one of the things that was kind of fun. I did share this with the name share a chart yesterday is how the thing. So one of my questions that came up was like, I remember a really bad Black Friday, but overall, I think Thanksgiving week is usually pretty bullish. So I did come across this. I just was doing my usual search, and we all use an AI now to find things that we wouldn't find otherwise, right? So I thought this was interesting. So basically, the Thanksgiving week effect. If you bought today, so you people watching it later, sorry you missed it by a day. You should have tuned in live, okay? Well, 3 hours ago, but that's another whole story. Oh, that's fine. You can probably get it on Monday. And the average gain was 0.64% over the week from today till next Friday. 68% win rate, which is pretty impressive. And the CAGR of 0.6% for just 1.6% of the year. So that's pretty impressive. So, and then they're saying like retail stocks on Black Friday do pretty well, but it's not as consistent. This was interesting. They said if you did long from the Black Friday close to the next week's close, it's got erratic gains. But if you do it from the Monday before Thanksgiving to December 1st, then you do pretty well, 74% win rate. So those people that are watching the recording, you can get in on Monday. There you go. And hold it till December 1st. Okay. And it's got a 0.5% CAGR, which is still pretty impressive, almost as much as the other one. And the best performing weekday is the Tuesday to Wednesday next week, apparently. So, and this is based on about 50 years worth of data. So,
I always find these like, especially the next Tuesday and Wednesday. I know I'm going to be thinking about that now. I'm be like, wait a minute, did this plan out this time? Win rate 80% though, that's really high.
yeah, I was hoping Rob Hanna, he wasn't there yesterday for share a chart because he's got some really good, you know, back testing data. He's always got some great analysis that's far beyond what I find and come up with. But anyway, so I bought some stuff today, so we'll see. So I threw some option trades on because I had some things that are a little high up right now after the big pullback yesterday. And but I filled them underneath with some more calendars today to kind of take that bottom edge and fill it out a little bit and figure as long as so I put a little bit of where we are. So if we go up a reasonable amount next week, even if it's not a huge amount, I should do fine. So anyway, for those watching at home, there's an idea to think about. If not next year, just put on your calendar. I'll forget it by then too. I'll probably put on
Right.
my
Oh, what happens around Thanksgiving again? Oh, it's looking up again.
yeah.
So,
Well, I know, and I know like Ryan and them, they use the seasonality for all these things and stuff. So quite a few people use seasonalities. And then this would lead into our Santa Claus rally typically anyway, right? So we'll see if we get a Santa Claus rally this year. We don't know. Actually, that's a good question. Where did it look like last year? I'm not making me dizzy going too fast. Well, see, last December we had the rally right up until then it dropped like on what, 19th or something. Huh? This might be profit taking too. I mean, when people are harvesting their losses,
Right.
capital gains, loss harvesting that last week of December is probably not the best time to be in the market unless you're. Take your losses a little earlier below the market's doing. I want to discuss here. Oh, then the other thing, what I really thought was interesting at Outlook was the speakers. We had a couple different speakers so we had Jim Bianco, right? And who was the other gentleman? I should pull my agenda here. And yeah, talked about how we are being fooled, or not us, because we know we're in the know now, Ben. But the average investor thinks they're buying the S&P 500 and they're getting all their risk spread across 500 stocks. I knew we were concentrated. I was actually kind of shocked by the level of concentration. I didn't know it was quite that high. I knew it was quite high for the tech stocks, but basically the top 20 stocks are almost half of the index now. So really 20 of the stocks is half the index, and the other, 480 stocks are the other half of the index. So, I mean, that's kind of insane, right? And the other thing they brought up, which I hadn't thought of, is that everybody with these 401ks, they're on an autopilot, right? So they're putting part of their paycheck in every week. Everybody's been told for the last, I don't know, 10, 20 years now, buy an S&P passive index fund, and that's the way you're going to be wealthy to retire. And so these indices just have automatic flow into them every week, right? So from that point of view, it's interesting. But when you look at it and say, NVIDIA is, 7% of the fund, they're up 32% this year. But for fun, let me go down here. I think I've got it here somewhere. This was a tweet by Kobasi. He's an interesting guy to follow. And he was just showing how NVIDIA is actually still 19% off its high for the year. So these tech stocks have made the majority of the returns, but on the other hand, they've come down from their highs earlier this year. So, and this was just put up, I think it was like 2 days ago or something like that.
It says 8 seconds ago. No,
yeah, well, I think it was. No, I think it was earlier today, actually. Either earlier today, yesterday. It wasn't that long ago. So anyhow, I thought that was really interesting. So, hey Thomas, can you let the dogs open the door for the dogs to go out, please? Sorry, my son's leaving to go pick up my other dogs. I've farmed it out today.
Do you know how much the concentration has changed over the last 10 years or so?
No, I tried to find out over the last 2 years, and Chat GPT failed me. I was trying to find out how much, because I think it's probably gone up a lot. They said it's gone up significantly, but they didn't have an exact percentage. So I don't know. That'll be something I'll try to do more research and find out. Yeah. And then this was Chat GPT's response saying that basically the top 20 is 49.6%. Their return of the top 20 is 22%, and the rest of the S&P is only gone up 1.4%. So that's that kind of the K-shaped economy they were talking about, or the K-shaped returns at the NAAIM Outlook conference, where all the tech has gone up. So I got to do it backwards. Tech's gone up this way, and the rest of the S&P is basically gone down that way, right? So you might get a K out of it. So I thought that was really interesting.
Yeah, no, I like that. I forgot about the K.
So I thought the K was great. And it applies to so many things right now, because one of the things he was saying, the affluent don't really care about tariffs and taxes because they only spend, I think he said, like less than 20% of their income on, on consumer-based things. And then, so they don't really care because most of their money's in the market, right? So the market keeps going up and they're getting richer. But the people that are living paycheck to paycheck, those tariffs and inflation have really killed them. And so now their basically net wealth has gone down because they're paying more for everything because 90% or 100% of their income goes to basically living expenses, right? So that was an interesting point. But
is there anything else? We got probably about a minute or two. I was just looking at the time. I got
that's fine. So
carried away in the conversation.
No. I'm almost on the last page here, so we're pretty good shape. So then that was just that, and then I just looked at the other thing I like to trade that I use for clients is the RSP. I don't know if you're familiar with that, the equal weighted S&P 500. So I use that. I was just looking at that. I was comparing that to the S&P over time. And it's interesting that short term, it hasn't done as well because the tech stuff in S&P has really gone up, as we saw in the last page. But long term, like over 10 years, I mean, there's a couple like a 1.8% difference, but it's not a huge difference. It's a lot less volatile. So one of the things I like to do is use RSP and then add like a QQQ or NDX or another NASDAQ sleeve to that. Because then what I can do is I can keep the RSP going, which pays some dividends. It's got the more, blue chip kind of stocks and things in it. And then I can turn on and off the exposure to tech based on if tech is in favor or it's getting beat up. So that's another idea that I like to do.
No, I like that. That's interesting.
Yeah. So just thought there was another thing that was interesting because we talked a little bit about RSP at Outlook as well. Because I know Ryan, I think, looks at it too. But it's just something for people at home watching that, you can consider this. You're going to still get decent returns, maybe not as much as the S&P 500, but if you don't want to have as much exposure to tech and just buy an index fund, you can do that too. Yeah.
Well, perfect. I think that was a great conversation. And forgot to ask you about an investment quote, I just realized, but
An
you
investment
didn't
quote.
have one on there, so
Oh,
it's all right.
no, that's right. Ben Franklin, I think it was Ben Franklin that said that compound interest is like the eighth world wonder or something like that. That was always one of my favorite quotes because we actually was in Philly last week, 2 weeks ago, and saw his grave and everything, and he was a very wise man. It was pretty cool. So it's
Oh
great.
no, definitely.
Yeah. So
Well, perfect. I think looking at yeah, so next week we will not have a name confidential episode because
I'll be
we'll
eating
be
pumpkin pie and
oh
or
yeah,
recovering from pumpkin pie.
recovering from it, spending money potentially and all that. So,
Yeah.
but Brad, I want to thank you for coming on here and sharing your vast amount of knowledge with us and the rest of the name community.
Well, thanks, Ben. I hope I didn't over talk too much, but I just thought I'd
Oh,
go over all kinds of good stuff here. Try to put something together that was interesting for people. So.
no, I had to look at the time. So I wasn't looking at the time. I had to look and go, oh, wait, whoa, we got to watch that.
No, so are you going to be in Tampa in the spring then for the Uncommon Knowledge?
I will always be there, bearing some
Yeah.
like drastic reason I can't be there. So, plus, I have to get better at cornhole because I have done terrible in the tournament the past few times.
Well, I have to tell you, 'cause I know we're out of time, but so we did a Boy Scout fundraiser, a cornhole tournament, and myself and another partner, we won 2 years in a row, beating the kids that were trash talking us the whole time. So I've gotten very serious now about learning to play cornhole just so I can beat
Yeah.
the scouts because they give me a hard time about it. So that's fine. So I'll try to practice up for Tampa as well. So
Well, maybe I just need to see if my sons can give me a hard time and I can use the same approach.
little push there, little
Yeah. Although a 3-year-old telling you that, it's gonna be a little bit
oh
different
God,
than
well, yeah, you're in a different part of life than I am.
Oh,
Believe me.
yeah.
Yeah.
Well,
Awesome.
perfect. Well, thank you so much, Brad. I hope you have a wonderful weekend and Thanksgiving coming up.
Yeah, have a great Thanksgiving. All right. Talk to you later.
All
Bye.
right, thank you. Bye.